My name's Stephen Barbridge. I'm a Research Manager for NAB Asset Management, and today I'm joined by Andrew Hamilton, Head of Research at Antares Equities. Thanks for your time, Andrew.
Hi, Stephen.
I believe one of the stocks that the investment team really like at the moment is Caltex. Given the focus on alternative energies and the popularity of electric cars, how do you think that'll impact kind of the future outlook for Caltex?
It's a great question, Stephen, and it's one that we do think about a bit. But it's one that's given rise to what we think is a great investment opportunity. Clearly, electric vehicles are here and they're only going to grow. However, at the moment, penetration of them is very, very small in terms of the total vehicle fleet. It takes the Australian vehicle fleet more than 10 years to turn over in its entirety. So we think really before electric vehicles are material in terms of their damage that they can do to total fuel distribution, you're looking at a decade and more. So when we run our valuation for Caltex, particularly a 10-year plus valuation scenario, we see that we capture most of the value in that 10 years, and at the end of that period they're left with significant physical asset value. And that's not even worrying about whether they can execute on their convenience retail strategy. We look at other companies in the Australian market where people aren't worried about disruption, companies like CSL and Cochlear being fantastic Australian companies. But something like 70 or 80% of their value it resides more than 10 years out, and there are issues like gene therapy and stem cell therapy that might in fact mean that they can't realise that value. Whereas for Caltex, everybody's entirely fixated on electric vehicles. Only about 40% of Caltex's value relies more than 10 years out. So we think that there's a real dissonance there between the way the market's looking at different stocks. Caltex is a business that's not well understood. They don't just sell fuel to we the consumer and to large companies. They import most of that fuel because Australia doesn't produce much oil. The import terminals are controlled by the 4 large majors. 49 of the 53 Australian import terminals are controlled by those 4 groups. The market isn't valuing that infrastructure at all. In fact, on our numbers, we estimate that infrastructure in Caltex's business only trades on about a multiple of about 5 times EBITDA, so earnings before interest, tax, depreciation and amortisation. Those same assets trade globally on multiples of 12 to 18 times. And so on our estimates, if Caltex were to achieve a valuation on those infrastructure assets of about 12 times at the bottom, that would add about $10 to their current share price of $34. So we think there's a real potential significant investment upside here from a company that is being impacted in its share price largely by sentiment.
Thank you, Andrew. That sounds like a really exciting opportunity. Thank you for your time this afternoon, and we'll see you next time.